Imagine waking up one morning to find that the money in your savings account has lost a significant chunk of its value, not because of any market crash or economic downturn, but simply because of a silent thief that has been stealing from you every single year. This thief is so stealthy, so cunning, that most people don't even realize they're being robbed, and yet it's a phenomenon that affects us all, regardless of our income, social status, or geographical location. The question is, are you aware that your savings are being slowly but surely eroded by this invisible force, a force that's been studied by economists and researchers for decades, and one that has a profound impact on our financial well-being? According to a study published in the Journal of Economic Psychology by researchers at the University of Cambridge, led by Dr. Daniel Redd, it's estimated that the average person loses around 2% of their savings every year due to this silent thief, which may not seem like a lot, but over time, it can add up to a staggering amount. A study conducted by Dr. Shlomo Benartzi, a renowned economist from the University of California, Los Angeles, found that people tend to underestimate the effects of this thief, which is known as inflation, by as much as 50%. This means that if you think you're earning a 5% return on your savings, you might actually be earning closer to 2% or 3% when you factor in the effects of inflation. But what's even more disturbing is that inflation doesn't just affect your savings. It also affects your purchasing power, which is the amount of goods and services you can buy with your money. As prices rise, the same amount of money can buy fewer and fewer things, which means that your standard of living is slowly but surely being eroded. For instance, if you had $10,000 in your savings account 10 years ago, you could buy a certain amount of goods and services with that money. But today, due to inflation, that same $10,000 can only buy around 80% of what it could buy back then, which is a significant reduction in purchasing power. According to a study published in the Journal of Monetary Economics by researchers at the University of Chicago, led by Dr. Robert Shiller, the average annual inflation rate in the United States over the past 50 years has been around 4%, which may not seem like a lot, but over time, it can have a profound impact on your financial well-being. Now, you might be wondering, how does inflation actually work, and why is it so destructive to our savings? Well, inflation is essentially a sustained increase in the general price level of goods and services in an economy over a period of time. It's measured as an annual percentage increase in the Consumer Price Index, which is a basket of goods and services that are commonly purchased by households. When inflation rises, the purchasing power of your money falls, which means that the same amount of money can buy fewer and fewer things. But what's even more insidious is that inflation can also lead to a phenomenon known as the money illusion, where people think they're earning more money because their salary has increased, but in reality, their purchasing power has actually decreased due to inflation. This can lead to a false sense of security, where people think they're doing better financially than they actually are, which can have serious consequences for their financial well-being. For instance, if you're earning a 5% annual salary increase, but inflation is rising at 3%, your real wage increase is only 2%, which means that your purchasing power is not increasing as much as you think it is. As we delve deeper into the world of inflation, it's clear that it's not just a simple economic concept, but a complex and multifaceted phenomenon that affects us all in different ways. According to a study published in the Journal of Economic Behavior and Organization by researchers at the University of California, Berkeley, led by Dr. Sindel Mullainathan, people's perception of inflation is often influenced by their personal experiences and biases, which can lead to a distorted view of reality. For example, if you've recently purchased a new car, you might think that inflation is higher than it actually is, because you're basing your perception on the price of that one item, rather than looking at the overall trend in prices. This can lead to a phenomenon known as anchoring bias, where people rely too heavily on one piece of information rather than looking at the bigger picture. But what's even more interesting is that inflation can also have a psychological impact on people, leading to feelings of anxiety and uncertainty about the future. When prices are rising, people may feel like they're losing control over their finances, which can lead to a range of negative emotions, from stress and worry to fear and even despair. The psychological impact of inflation is a fascinating topic, and one that has been studied extensively by researchers such as Dr. Daniel Kahneman, a Nobel laureate in economics from Princeton University. According to Dr. Kahneman, people tend to be loss-averse, meaning that they prefer to avoid losses rather than acquiring gains. This means that when inflation rises, people may feel like they're losing money, even if their salary is increasing, which can lead to a range of negative emotions. But what's even more interesting is that inflation can also affect people's behavior, leading them to make different financial decisions than they would in a low-inflation environment. For instance, when inflation is high, people may be more likely to spend their money now rather than saving it for the future because they know that the purchasing power of their money will be lower in the future. This can lead to a range of consequences, from reduced savings rates to increased debt levels, which can have serious implications for people's financial well-being. As we continue to explore the world of inflation, it's clear that it's a complex and multifaceted phenomenon that affects us all in different ways, and one that requires a deep understanding of its causes and consequences in order to mitigate its effects and protect our savings from its silent theft. And it's with this understanding that we can begin to develop strategies to overcome the negative effects of inflation and ensure that our savings continue to grow in value over time. But for now, let's just say that the impact of inflation on our savings is a topic that deserves much more attention than it typically receives, and it's an issue that we'll continue to explore in more depth as we delve deeper into the world of personal finance and the many challenges that we face in our daily lives, including the silent thief that's always lurking in the background, waiting to strike, and that's inflation, a force that's always at work, eroding the value of our savings and reducing our purchasing power. And it's a force that we must understand and respect if we want to achieve our long-term financial goals. And that's a topic that we'll continue to explore as we move forward and examine the many ways in which inflation affects our lives and the strategies that we can use to mitigate its effects and protect our savings from its silent theft. But for now, let's just say that the impact of inflation on our savings is a topic that deserves much more attention than it typically receives. And it's an issue that we'll continue to explore as we delve deeper into the world of personal finance and the many challenges that we face in our daily lives. And that's where we'll pick up in the next part of our discussion as we continue to explore the world of inflation and the many ways in which it affects our lives and our savings. And that's a topic that we'll continue to explore as we move forward and examine the many ways in which inflation affects our lives and the strategies that we can use to mitigate its effects and protect our savings from its silent theft. And it's a topic that will continue to be of great importance as we navigate the complexities of the economy and the many challenges that we face in our daily lives. And that's where we'll pick up as we continue to explore the world of inflation and the many ways in which it affects our lives and our savings. And that's a topic that will continue to be of great importance as we move forward and examine the many ways in which inflation affects our lives and the strategies that we can use to mitigate its effects and protect our savings from its silent theft. So, now that we've covered the basics of inflation and how it works, let's dive into some real-life examples to make this concept more relatable. Imagine you had $10,000 in a savings account 5 years ago, and you didn't touch it since then. At first glance, it might seem like your money is still worth the same, but in reality, its purchasing power has decreased significantly due to inflation. According to a study by economist David Blanchflower, the average inflation rate in the U.S. over the past few decades has been around 2 to 3% per year, which might not seem like a lot, but it adds up over time. To put this into perspective, let's say you had $10,000 in that savings account, and the inflation rate was 2.5% per year. After 5 years, your money would have the same purchasing power as around $9,100 in today's dollars. That's a loss of $900 in just 5 years, without even taking into account any potential interest earned on the account. This might not seem like a lot, but it's a silent thief that's stealing from you every single year. As researcher Robert Shiller once said, inflation is a subtle and insidious process that can erode the value of money over time. Another study by economist Joseph E. Stiglitz found that inflation can have a disproportionate impact on certain groups of people, such as the elderly and those on fixed incomes. This is because these individuals often have a limited ability to adjust their spending habits or increase their income to keep up with rising prices. For example, if you're living on a fixed income of $2,000 per month and the inflation rate is 3%, your purchasing power will decrease by around $60 per month. This might not seem like a lot, but it can add up over time and make a big difference in the quality of life for these individuals. So, what can you do to protect your savings from the effects of inflation? One practical step is to consider investing in assets that historically perform well during periods of inflation, such as precious metals or real estate. For example, gold has traditionally been a good hedge against inflation, as its value tends to increase when the value of the dollar decreases. Another option is to invest in index funds or ETFs that track the overall market, as these tend to perform well over the long term and can help keep pace with inflation. Another step is to review your budget and see where you can cut back on unnecessary expenses. By reducing your spending and allocating that money towards savings or investments, you can help keep pace with inflation and even get ahead. For example, let's say you spend $500 per month on dining out, and you could cut that back to $200 per month by cooking at home more often. That's an extra $300 per month that you could put towards savings or investments, which can add up over time. Finally, it's essential to stay informed and educated about personal finance and investing. By learning more about how inflation works and how to protect your savings, you can make informed decisions about your money and avoid common pitfalls. For example, you could read books or articles on personal finance, or listen to podcasts or videos like this one. By taking control of your financial education, you can take control of your money and achieve your long-term goals. In conclusion, inflation is a silent thief that can erode the value of your savings over time. However, by understanding how it works and taking practical steps to protect your money, you can stay ahead of the game and achieve financial freedom. Remember, it's not just about saving money. It's about preserving its purchasing power over time. By investing in assets that perform well during periods of inflation, reducing unnecessary expenses, and staying informed about personal finance, you can protect your savings and achieve your long-term goals. It's also important to note that inflation can have a significant impact on your retirement savings. For example, if you're saving for retirement and expecting to live on a certain amount of money, inflation can reduce the purchasing power of that money over time. This means that you may need to save more than you think in order to maintain your standard of living in retirement. By understanding how inflation works and taking steps to protect your savings, you can ensure that you have enough money to live comfortably in retirement. In addition to investing in assets that perform well during periods of inflation, you can also consider other strategies such as dollar-cost averaging or diversifying your portfolio. Dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of the market's performance. This can help reduce the impact of inflation and market volatility over time. Diversifying your portfolio involves spreading your investments across different asset classes, such as stocks, bonds, and real estate. This can help reduce risk and increase potential returns over the long term. By taking a proactive approach to managing your finances and understanding how inflation works, you can protect your savings and achieve your long-term goals. It's not just about saving money. It's about preserving its purchasing power over time and making informed decisions about your financial future. If this helped you think about money differently, subscribe. I post new finance insights every single day. And if you want to go even deeper, check the link in the description for the little book of common sense investing by Bogle. It changed how millions of people think and act.